turn 73 and the government requires you to start withdrawing money from most of your retirement accounts, whether you need the cash that year or not. This is the Required Minimum Distribution, or RMD, and getting it wrong is one of the most expensive mistakes in retirement planning. The penalty for missing it is steeper than almost anything else in the tax code. For 2026, that age is 73 if you were born between 1951 and 1959. If you were born in 1960 or later, the Internal Revenue Service pushes your starting age back to 75. This came from the Secure 2.0 Act, which raised the RMD age in 2 steps depending on when you were born. Check your own birth year against the current rule before you plan around it. The age you were told a few years ago may no longer apply to you. The math itself is simpler than most people expect. Take the balance in the account as of December 31st of the prior year and divide it by a number called a life expectancy factor. The IRS publishes that factor in what's known as the Uniform Lifetime Table. At age 73, that factor is 26.5. So if your traditional individual retirement account, or IRA, held $500,000 at the end of the prior year, your RMD for the year would be $500,000 divided by 26.5. That comes out to roughly $18,868. That factor gets smaller every year you age, which means the percentage of your account you're required to withdraw rises gradually over time. Here's where people mixing account types get tripped up. If you own multiple traditional IRAs, the IRS lets you calculate the RMD separately for each one, add them together, and withdraw the total from any single IRA, or split it across several. The accounts talk to each other. The same is true if you hold several 403(b) contracts. Those can also be combined with each other. But workplace plans like 401(k) accounts do not get this treatment. Each 401(k) you own requires its own separate withdrawal, calculated on its own balance. You cannot satisfy one 401(k)'s requirement by pulling extra from another account. Mixing an IRA withdrawal with a 401(k) requirement is a common and costly error. Picture someone with 2 traditional IRAs and one 401(k). Say the RMD on the first IRA comes to $6,000 and the second comes to $4,000 for a combined $10,000. That whole amount can come from either IRA or be split between them, however it's convenient. But if the 401(k)'s own RMD comes to $7,000, that $7,000 has to come out of the 401(k) specifically. Taking an extra $7,000 out of an IRA instead does not satisfy the 401(k) requirement, even though the total dollar amount withdrawn looks the same on paper. Before we move on, one quick aside on account types. Roth IRAs carry no RMD at all for the original owner, so they're left out of this calculation entirely. The first year creates a trap of its own. The IRS gives you until April 1st of the year after you reach your RMD age to take that very first distribution. It sounds like a grace period, and in a sense it is, but that delay does not erase the second RMD that's still due by December 31st of that same year. Delay the first one, and you could find yourself taking 2 distributions in a single calendar year. The delayed one from the prior year, and the regular one for the current year. Both land on the same tax return. Say your RMD for the year, you turn your threshold age, works out to $20,000, and you wait until March of the following year to take it. You still owe a second RMD for that following year too. typically in the same rough range. Both the account balance and the required percentage only shift slightly from one year to the next. Take both in the same 12 months and $40,000 of retirement income lands on one tax return instead of being spread across two. That stacking matters because both withdrawals count as taxable income in the same year. Two RMDs landing together can push your income into a higher tax bracket than either withdrawal would on its own. And if you're on Medicare, a spike in income can echo forward as a higher monthly premium 2 years later. Medicare bases that adjustment on a tax return from 2 years back. Whether delaying to April 1st or taking the first distribution in the same year you turn your RMD age, works better for you depends entirely on your other income that year. There is no single right answer, and it's worth working through both scenarios with your own numbers before deciding. Miss an RMD altogether, or withdraw less than required, and the penalty is an excise tax of 25% on the shortfall, the amount you should have withdrawn but didn't. Go back to that $18,868 RMD from earlier, skip it entirely, and the shortfall penalty alone comes to $4,717. That's money owed to the IRS before you've spent a cent of the withdrawal itself. Correct the mistake within 2 years using Form 5329 to report it to the IRS. That penalty drops to $1,887 instead. This penalty was lowered from a flat 50% under the Secure 2.0 Act, so it's less punishing than it used to be. But a 4-figure bite out of a single missed withdrawal is still a real cost for a paperwork error. None of this changes based on how well-intentioned the mistake was. A $4,000 penalty doesn't care whether you meant to combine the wrong accounts or forgot the April deadline. The rule applies the same way regardless. If you're approaching your RMD age, the safest move is to map out which accounts aggregate with which. Confirm your exact age threshold and decide deliberately whether taking that first distribution early or late fits your tax picture. On this one, the calendar and the calculator both matter. Getting either wrong is what turns a routine withdrawal into a 4-figure check to the IRS. Thank you for watching all the way to the end. If this video gave you something to think about, do one small thing. Subscribe to Retirement Decisions Desk. Every video here unpacks one retirement decision, and subscribing is how you'll never miss the next one. Take care of yourself, and I will see you in the next video.